On January 30th, 2026, Kevin Warsh was nominated as the next Federal Reserve Chair. Within 48 hours, gold collapsed 13%. Silver crashed 39%. Most people believe this was just a hawkish surprise, a shock that strengthened the dollar and crushed precious metals. You see, that's the official narrative. But the fine print tells a different story. This wasn't a surprise. It was a coordinated extraction. A liquidity trap designed to shake out the weak hands before the real pivot begins. Today, I'm breaking down the three-stage mechanism behind the Warsh Shock, Stage 1, the leverage trap that erased $7.4 trillion in 48 hours. Stage 2, the 70% BRICS pivot that's rewriting the rules of the gold market. And Stage 3, the legal loophole that means you never actually owned your metals in the first place. A mandatory protocol before we open the file. This is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Let's start with what happened on January 30th. Kevin Warsh, former Federal Reserve Governor, known inflation hawk, architect of the 2008 quantitative tightening framework. His nomination was announced at 9:47 a.m. Eastern Time. By market close, gold had fallen from $2,893 per ounce to $2,518, a loss of 13%. Silver, it went from $32.60 per ounce to $19.87, a 39% collapse. The headlines called it a dollar rally. They said the markets were pricing in higher interest rates and a stronger currency, which means they want you to believe this was organic. A simple reaction to monetary policy expectations. But here's what they aren't telling you. The CME Group, the Chicago Mercantile Exchange, raised margin requirements on gold and silver futures contracts the moment the Warsh news broke. Margin requirements are the amount of collateral you need to hold a leveraged position. If you're trading futures with 10-to-1 leverage, a small margin increase can force immediate liquidation. On January 30th, the CME raised gold futures margins from $7,000 per contract to $11,500, a 64% increase. Silver margins went from $6,000 to $14,000, a 133% increase. You see, this wasn't about fundamentals. It was about forced liquidation. Traders holding leveraged long positions in gold and silver had two choices: post more collateral immediately or close their positions at a loss. Most chose liquidation. The result? $7.4 trillion in global market capitalization was erased in 48 hours. Not just in precious metals, but across commodities, emerging market currencies, and even Bitcoin, which means the Warsh nomination wasn't the cause, it was the trigger. The mechanism was already in place, plus, this margin shock didn't happen in isolation. Between January 15th and January 30th, just 2 weeks before the Warsh announcement, the Federal Reserve quietly drained $112 billion in liquidity from the repo market. The repo market is where banks and institutions go for short-term funding. When liquidity dries up, leverage positions become toxic. Collateral gets called. Margin calls cascade? The math is simple. Remove liquidity. Announce a hawkish Fed chair. Raise margin requirements. Watch the liquidations. The banks holding the short positions? They covered at the bottom. They extracted maximum value from the weak hands who bought metals as a hedge against inflation and instability, which means the very assets you bought for safety were used as a liquidity trap for the big banks. If this specific mechanism just clicked for you, or you want to track these macroeconomic shifts as they happen, join the Forensic Circle by hitting subscribe. Let's move to the deep dive. But even the $7.4 trillion extraction is a distraction from the real trap hidden in the fine print of your brokerage account. Because while the Warsh Shock was shaking out retail investors, BRICS was quietly seizing control of 70% of the world's physical gold reserves. And the legal loophole buried in Uniform Commercial Code Article 8 means you never owned your metals in the first place. Here's the smoking gun. While the Warsh Shock was engineered to flush out retail positions in paper gold and silver, BRICS was executing the largest physical gold accumulation in modern history. And by late 2026, the bloc is on track to control 70% of the world's gold reserves. Not 70% of new production, 70% of total global reserves. BRICS. As of January 2026, the combined central bank gold holdings of the BRICS bloc stood at 41,300 metric tons. Total global central bank reserves? Approximately 59,000 metric tons. That's already 70%. But here's where the math gets surgical. China's official gold reserves are listed at 2,264 metric tons. That number hasn't changed since 2019, you see. The People's Bank of China stopped reporting monthly gold purchases in 2019, but import data from Switzerland, the UK, and Hong Kong tells a different story. Between 2019 and 2025, China imported an additional 8,600 metric tons of gold through backdoor channels, which means China's real reserves are closer to 10,800 metric tons, not 2,000. Plus, Russia has been selling oil and natural gas to China and India exclusively in yuan and rupees since the SWIFT sanctions in 2022, but those yuan and rupee reserves don't sit in a vault. They're immediately converted into physical gold on the Shanghai Gold Exchange. Russia added 1,200 metric tons between 2022 and 2025 alone. India? Another 900 metric tons. The math is no longer speculative. It's documented in customs data, refinery reports, and bilateral trade agreements, which means the 70% threshold isn't a projection, it's already crossed. Now, why does this matter? Because BRICS isn't accumulating gold to sit on it. They're building the infrastructure for a gold-backed trade settlement system. The name of the system? The unit. It's not a replacement for the dollar in domestic economies. It's a bypass mechanism for international trade. Here's how it works. Let's say China wants to buy oil from Saudi Arabia. Under the current system, both countries need to convert their currencies into US dollars to settle the transaction. Which means every barrel of oil, every ton of copper, every container of soybeans traded globally creates artificial demand for the dollar. This is the foundation of dollar hegemony. It's not backed by gold. It's backed by the fact that you need dollars to participate in global trade. The unit changes that. Under the BRICS system, China and Saudi Arabia settle the oil trade in units. The unit is pegged to a basket of commodities, with gold as the dominant anchor. No dollar conversion, no SWIFT network, no Federal Reserve intermediation. The pilot program launched in October 2025 with limited bilateral trades between China and Russia. the exact institutions that were on the other side of the Warsh Shock liquidations, which means you don't get the medal. You get a claim in bankruptcy court. The U.S. national debt is $38 trillion. Interest payments alone exceeded $1 trillion in 2025. Debt to GDP ratio, 123.6%. That's higher than Italy. Higher than Greece before the Eurozone crisis. Plus, the Congressional Budget Office projects the deficit will reach $2.6 trillion by fiscal year 2027. The math is unsustainable. Now, combine that with the commercial real estate maturity wall. Between January and December 2026, $1.5 trillion in commercial real estate loans come due. Office vacancy rates in major U.S. cities are at 43%. That's higher than during the 2008 financial crisis, which means a significant portion of those loans will default. When those defaults cascade through the banking system, liquidity dries up, margin calls trigger, collateral gets seized. And if you're holding gold or silver through an ETF, your entitlement becomes subordinate to the bank's secured creditors under UCC Article 8. It was about shaking out the weak hands before the real reset, the 70% BRICS pivot, the unit currency, the maturity wall, the legal loophole in your brokerage account. These aren't isolated events. They're stages in a scripted transition, which means the question isn't whether the system resets. The question is whether you're positioned on the right side of the fine print when it does. But even this 70% gold control is just the mechanism, the script. The historical pattern that guarantees this reset has played out 3 times before. And the U.S. is following the exact same 7-stage collapse cycle that destroyed the Spanish Empire in the 1590s. Here's what the data shows. The cycle we're watching in 2026 isn't new, it's a script. And it's been executed 3 times in the last 500 years. The Spanish Empire, 1596. The British Empire, 1947. The Soviet Union, 1991. All 3 followed the same 7-stage pattern. All 3 controlled the reserve asset of their era. All 3 believed they were exceptional. The math didn't care. Let me walk you through the stages. Stage 1, military overextension. The empire expands its military presence beyond its economic capacity to sustain it. Bases proliferate. Wars multiply. Defense spending becomes structural. Spain in the 1580s maintained garrisons across the Netherlands, Italy, North Africa, and the Americas. The cost? 60% of total crown revenue. The U.S. in 2026 operates 800 military bases in 80 countries. Defense spending for fiscal year 2025 reached $916 billion. That's 35% of discretionary federal spending. Plus, the wars don't end. They metastasize. Iraq, Afghanistan, Syria, Ukraine proxy funding, Taiwan contingency planning. The pattern holds. Stage 2, currency debasement. The empire begins inflating its currency to finance the military overextension. The reserve asset loses purchasing power, wages stagnate, asset bubbles form. Spain debased the silver real 4 times between 1590 and 1596. Each debasement reduced the silver content by 12 to 15%. The result? Domestic inflation hit 43% between 1592 and 1596. Bread riots erupted in Seville and Madrid. The U.S.? The Federal Reserve expanded the monetary base from $870 billion in 2008 to $8.2 trillion by 2025. That's a 942% increase in 17 years. Which means every dollar in circulation in 2008 is worth 11 cents today in real purchasing power. The pattern holds. Stage 3, debt spiral. The empire reaches a point where interest payments on accumulated debt exceed revenue growth. The only way to service old debt is to issue new debt. Spain's total debt in 1596 reached 14 times annual crown revenue. Interest payments consumed 84% of incoming tax receipts. King Philip II defaulted 4 times: 1557, 1565, 1575, 1596. The U.S. national debt is $38 trillion. Annual federal revenue in 2025 was $4.9 trillion. That's a debt-to-revenue ratio of 7.7 to 1, plus interest payments exceeded $1 trillion for the first time in 2025. That's 20% of total revenue. And here's the surgical detail. The Congressional Budget Office projects interest costs will hit $1.7 trillion by 2029, which means within 3 years, interest alone will consume 35% of all revenue. You see, this is stage 3, the debt spiral. Once you cross this threshold, there is no policy tool that reverses it without default or hyperinflation. The math is binary. Stage 4, loss of productive capacity. The empire begins losing its ability to produce real goods. Manufacturing moves offshore. The trade deficit becomes structural. The domestic workforce shifts from production to services and financialization. Spain lost its textile industry to the Dutch and English between 1580 and 1600. By 1620, Spain imported over 70% of its manufactured goods despite controlling the silver mines of Potosi. The paradox? Spain had the gold and silver, but couldn't produce the goods those metals could buy. The U.S. manufacturing base peaked in 1979 with 19.6 million factory jobs. By January 2026, 12.1 million. That's a 38% decline in productive capacity. Plus, in the first 9 months of 2025 alone, 73,000 manufacturing jobs were eliminated. The trade deficit for 2025 hit $1.2 trillion. The U.S. imported $612 billion more in goods than it exported, which means the U.S. is now in stage 4, the productive base is collapsing while the currency is still the global reserve. This is the exact inflection point where Spain was in 1592. Stage 5, loss of reserve currency status. The empire's currency is no longer accepted as the primary medium of international trade. Alternative systems emerge. Bilateral agreements bypass the old reserve. Spain's silver real was the global reserve currency from 1550 to 1620. But by 1610, the Dutch guilder and the British pound sterling had replaced it in over 60% of European trade. Why? Because Spain's serial defaults destroyed confidence in the crown's ability to honor its obligations. The U.S. dollar became the global reserve in 1944 under the Bretton Woods Agreement. By 2026, the dollar's share of global foreign exchange reserves has fallen from 71% in 1999 to 58%. Plus, the BRICS unit system launching in late 2026 represents 46% of the world's population and 32% of global GDP. Saudi Arabia, the UAE, and Iran, 3 of the top 5 oil exporters, are all piloting non-dollar settlement mechanisms, which means we are in the early phase of Stage 5, the reserve is fragmenting. Stage 6, social fracture. The empire experiences domestic unrest as the wealth gap becomes unsustainable. The middle class is hollowed out. Trust in institutions collapses. Extremism rises on both ends of the political spectrum. Spain experienced the revolt of the Comuneros in 1520 and the Morisco rebellions in 1568. Both were driven by tax revolts and wealth concentration in the hands of the aristocracy. The U.S. wealth gap in 2025, the top 1% holds 32.3% of total wealth. The bottom 50% holds 1.5%. That's a 21-to-1 ratio. Plus, trust in federal institutions hit an all-time low of 19% in a Pew Research poll conducted in October 2025. Political violence incidents increased 43% between 2020 and 2025, according to data from the Armed Conflict Location and Event Data Project. We are not yet fully in Stage 6, but the preconditions are mathematically in place. Stage 7, collapse or reconfiguration. The empire either collapses entirely or reconfigures into a smaller regional power. The reserve currency is abandoned. The military footprint contracts. The standard of living declines for decades. Spain reconfigured into a regional European power by 1650. It lost the Netherlands, Portugal, and most of its Italian holdings. The population declined by 20% between 1600 and 1650 due to famine, plague, and emigration. The British Empire formally ended in 1947 with Indian independence. Within 20 years, Britain had lost 90% of its colonial holdings. The pound sterling was devalued 6 times between 1947 and 1967. The Soviet Union collapsed in 1991. The ruble lost 99% of its value between 1991 and 1998. Life expectancy dropped by 6 years. You see, the U.S. in 2026 is somewhere between stage 4 and stage 5. The productive capacity is collapsing. The reserve status is fragmenting. The debt spiral is irreversible without default. The script has been written 3 times. The math doesn't care about exceptionalism, which means the Warsh Shock, the BRICS pivot, and the UCC Article 8 trap aren't isolated events. They're the mechanisms that accelerate the transition from stage 4 to stage 5. The only variable left is time and the timeline. The 2026 maturity wall, the unit currency launch, the 70% gold threshold suggests that time is running out faster than the official narrative admits.
Most people will ignore this 39% silver warning and pay the price. They'll believe the headlines. They'll trust the entitlement holder status in their brokerage account. They'll assume the system protects retail investors. You see, the script doesn't reward assumptions. It rewards those who read the fine print. If you refuse to be a victim of the script, if you're the type of person who holds yourself to a different standard, subscribe to the Forensic Circle. We don't predict the future. We read the math, and the math is already written. Here's what the data shows. The Warsh Shock wasn't a surprise. It was a liquidation event designed to extract $7.4 trillion from leveraged positions before the real pivot. The BRICS bloc is on track to control 70% of global gold reserves by late 2026. The unit currency is already in pilot phase. The petrodollar system is being systematically dismantled. Plus, the legal structure buried in Uniform Commercial Code, Article 8, means most retail investors never owned their metals in the first place. They owned a claim, and in a collapse, claims are subordinate to secured creditors. The US is following the exact 7-stage collapse pattern that destroyed Spain, Britain, and the Soviet Union. We're currently between stage 4 and stage 5.